Hello and welcome. You're watching Lessons in Financial Literacy, a show presented by MCX. Today we'll be talking about a very interesting topic, technical analysis, and why is it important when looking at the stock market. We'll also tell you how we can make technical analysis work for you and tell you exactly what it entails. To help us understand more about technical analysis, we have with us two very special guests. Hemant Kale, Director of Maya Financial Services, joins us, and we've also got Sarvendra Srivastav, Technical Strategist of MK. Thanks very much, gentlemen, for joining us today. Hemant, just to get started, define technical analysis for me and tell me how does it work in the volume and price parameter?
Well, technical analysis is actually the study of price. It is the study on the price of the past which has happened. And based on the price patterns or the price structures that are seen on the chart, there is a forecast that is made on what would be the likely movement of price in the future. Right. That's the basic study of technical analysis.
Right, and how important is volumes as part of
volumes are very critical as far as the trends go, because the volumes have to support the trends, because in technical analysis, price moves in trends is one of the basic assumptions. Right. So volumes come into effect only when trends are in progress.
Okay. Right, Hemant, you know, where did this origin from? What is the difference when you compare them? I mean, we all talk about fundamentals because that's, of course, easier access, it's qualitative resources in front of you. Tell me about the difference between fundamentals and technical analysis, and also where did this technical analysis origin from? Since when have we been actually using this to analyze the stock market?
Well, technical analysis has originated in the year 1900 when Sir Charles Dow is supposed to be known as a granddaddy of technical analysis. He was the originator of these technical analysis concepts. He developed certain tenets or certain characteristics of technical analysis. Now, coming to fundamental analysis is basically a method of analysis of securities, where what is done is you analyze the economy, you analyze the sector, you analyze the financials of the companies, and you make a financial forecast. And that financial forecast helps you to basically look at whether the stocks are currently valued, overvalued, undervalued, or they are rightly priced. Technical analysts have a different belief, have different style of working. What technical analysts actually do is they believe that price is a result of demand and supply. Okay. And demand and supply for the stock actually results from the perception towards the fundamentals which are existing.
Okay.
So technical analysts believe that everything is discounted by the price. So they study the price behavior, the price patterns which are there on the chart, and try to forecast based on the previous price behavior.
Right, very quickly, can I ask you if fundamental analysis and technical analysis, do they complement each other literally, or they would work independently?
Actually, they work independently, but it's better that every investor who gets into stock market complements both of these different techniques of analysis, because that will help him to achieve his targets or achieve his profits in a better manner.
Right, Sarvendra, also the ground rules are the same, right, for any market or any stock. So whatever works for a frontliner like Reliance Industries would also work for a small cap player like PPL. Would that be correct if I say that, or would technical analysis be different in terms of the trading parameters for a large cap and a small cap, or a developing market and, of course, an emerging market?
See, there could be, the basic tenets would remain the same. There could be slight variations in the types of trends and the kind of volatility that a large cap or a small cap would show you. So typically a large cap would show you less volatile parameters than probably a small cap. So vis-a-vis both of them, I think the tenets would remain same. Only is that you would want to use longer term averages on a small cap stock, and with a large cap you could also do slightly shorter term analysis.
Right, you all both talked about the fact that historic data is something that's fairly important when you're looking at technical analysis. So, if you just want to tell me that the history of a trading pattern of a stock, aside from year as it is or the price of it, how important is the historic data when predicting a future trend?
See, for people like us who probably trade the wave principle, as long as you can go in history and get the price data, that would be perfect. So on my chart, I would want to have that data right from the day one of trading. That could be 5 years, 5 months, 50 years or 100 years. So on my charts, probably freely available Dow Jones data I have from 1920s.
Right.
So I could plot that. But for Sensex, we have data only from 1970s, 80s. So that is the limitation. Sensex has been trading from that time. So that data has got limited to that time frame. But I would want the day one of any asset to be there on the price chart from the day it started trading.
Right, Hemant, that brings me to a question. I mean, we've done a show together where you've got a number of queries coming in from investors of very recent listings, where, of course, you've got limited information because the stock is probably listed 6 months ago, 3 months ago. It's generally with the delta of IPOs that we've actually seen recently. In that case, what kind of historic timeline are you talking for having a genuine judgment of a future analysis of a stock? So would you say 3 months of historic data is important? Would you say 6 months? What is the minimum that you require?
Well, Sabina, what I feel in this is the time frame of the investor is more critical than the actual data which is there on the on the charts.
Right.
Because if a person is there who is a long-term investor and I have only 3 months kind of data on my chart, then really I will not be able to give him justice. But if he is an investor and if he's a trader and I have only 3 months of data, then I think that's sufficient data for me to understand the movements, because he needs some investments that have to be done for shorter period of time. So the larger the data, the more longer term investors and more longer term trends could be determined in a very effective manner. But when the data is short, I think the traders' judgments can of course be made.
And to learn more about technical analysis, we have with us our very own Guru Mani. Guru's to tell us who all can use technical analysis. Is it just for short-term traders or long-term investors can also use this?
Samina, technical analysis can be used by long-term investors and short-term traders to determine the price movement of a security.
Well, that also I want to ask you this, because this is something that we hear a lot about. You'll always have your long-term investors who talk about, investing in stocks depending on valuations, fundamentals, what is the outflow, what is the PE. What about the fact, how important is technical analysis for long-term investors? You normally hear of them talking about a short-term trade. So if you've got an intraday trade, you will use technical analysis. So can long-term investors also use technical analysis, or it's best suited for a short-term trader?
Well, technical analysis was originated by Charles Dow for long term. It was never originated for short term. But with the advent of our computers and with the advent of modern softwares, actually technical analysis has been put to a shorter term. Question is, whenever you want to look for longer term, we move to longer term charts. And whenever you want judgments on for a smaller or shorter duration, we look at shorter term chart or intraday charts. So it's the time frame of the investors which is critical. So a judgment can be made for shorter term as well as a longer term using technical analysis. But I think fundamental would be restricted to only long term.
Right, very quickly, would the charts that are looked at for short-term traders be different from long-term investors, or it's the same data points again?
See, essentially the price data would remain the same.
The same, okay.
All you can do is shift time frames. So an intraday trader would want to look at hourly charts. A slightly 4-5 day kind of a player, or a week, someone who holds a trade for a week would want to look at daily charts.
Right.
Someone who has a slightly higher horizon, say a month or so, would want to look at weekly, monthly charts.
Okay.
And an absolutely long-only kind of a fund would want to look at even quarterly and yearly charts. So it purely depends on what kind of a time frame you want to trade. And that is what the end investor can only decide. An analyst cannot decide. My time frames need not definitely match with the guy who's investing. So you have to decide your time frame and accordingly go and look at the time frame on the chart.
Right, on that note, we'll slip in a quick break, but when we come back, we'll talk about very commonly used terms like trend, what is a stop loss, what is, of course, support and resistance levels. Welcome back. You're watching Lessons in Financial Literacy. Just moving on from there, Sarendra, I'm going to take this with you. Let's talk a little bit more about one of the most commonly used terms, which is trend. You know, a lot of people talk about how trend is your friend. Can you elaborate a little more about that? What does trend really mean to begin with?
See, for a layman, a trend would be when prices are going 3 steps up and they are going back 2 steps. And again they are going 3 steps up and again coming only back 2 steps. That would be an uptrend, where you are moving more on the upside, and when you are correcting less. And vice versa, in a downtrend you would be going down 3 steps and you are just moving back 2 steps. Then again you are going down 3 steps and you are moving back 2 steps. So that would define a downtrend where prices are going down more and pulling back less, and then going down more and then pulling back less. That would give you net a movement which would be going down. So that would amount to a downtrend.
So then this would be an uptrend, right? Because of course you've got bars in the green that are indicating an up move.
Correct.
And while you've got the ones in the red, right?
Right. That's what we need to see is the moves which are going up are much larger than the falls. So all the rises are much larger than the falls which you can see there. So that basically tells us that there is more power of the bulls and less power of the bears. So bears are not able to actually push the price down. So that makes an uptrend.
Okay, that would be the downtrend. Now how does that...
Yeah, in this case, if you typically observe this chart, you will see that the falls are much larger and the rise is less.
You mean the price falls are larger?
Price falls are larger, and
so you either gain by 2 rupees and fall by 10. So then that obviously means that there's...
No, the fall is 10 rupees and the gain is 2 rupees.
Then you're in a downtrend.
Then we are in the downtrend,
Okay.
and this actually results into a lower top, lower bottom kind of formation, which we actually keep talking as technical analysts on channels.
Right. Also, just to talk about something that's very commonly talked about, support and resistance. Please tell me what this is, because I mean you always have stocks and you'll always have investors asking you what is the support, because you'll always have analysts saying this is the support, X is the support, Y is the resistance. There's a chart as well that we've got, so if you can just help us understand the importance of this and how it works.
See, support and resistance is nothing but demand and supply. So if we have to look at this particular chart, in the first half of the chart, if you see when prices fell all the way from 90 till 57, the first decline.
Yeah.
After a small pullback, a second time also they went and just made a bottom around the 57 mark. So we had two bottoms in close succession around the 57 mark, and prices refused to go lower.
Okay.
Right?
Yeah.
When such a situation happens and prices start to look up again, then with some percentage from that low, say we can put a filter that once the price moves 3% away from a double bottom or a support area which is at 57, you would say that now 57 has become a short-term support for the prices, and then prices start to move up, right? And similarly, if you look at the 89-90 mark, there have been quite a few tops. First there were two tops around the 89 mark, then when we fell all the way from 57, the first pullback all the way till 89 also found resistance, which means prices struggled to go past 89, and there was too much of supply which was stopping prices from breaking past 89. So till that point in time, 89 continued to remain a resistance for the stock. Then towards September, October, you can see that big breakout out of the 89 levels when prices went all the way till 97. From then onwards, there was a role reversal, and the 89 level, which was earlier a resistance all the way from April till September, October, it has now shifted role and become a support. So support resistance are areas which keep on shifting gears depending on which side of the
fence you're sitting on.
Yeah. So as long as the prices remained above 89 till late December, the stock was okay, and you would have said that 89 is a good support and the stock is finding good support at 89. But then see how in late December how the stock then again fell below 89,
yeah.
and at such a point 89 again reversed the role from a support. Now from henceforth it has become a resistance.
Right.
So at support and resistances, the demand-supply equation changes, and when demand is sufficient enough to meet supply, it's a support, and when supply is enough to meet demand, it becomes a resistance.
So the only variable there would be time, because depending on the time that you're talking,
yes,
those factors of course exchange their roles. Also, how much of this has to do with the stop loss? Because would a support level be a stop loss for an investor when he's buying a stock?
Yes, if someone has taken a trade on a breakout of a resistance particularly, then that, suppose in this case when we broke out of 89 and someone would have taken a trade at that breakout with an X filter, say a 3% filter. So when prices broke above 89 plus 3%, you took a long trade. At that point in time, your stop loss would be somewhere below 89, or 89 would be your stop loss. And then you will want the trade to mature on the upside and get your targets. Similarly, on that same chart, when we had a double bottom support at 57, if you would have taken a buy trade with a 3% filter, 57 plus 3%, you would have taken a buy trade. Then 57 or just slightly below 57 is your stop loss for that trade, and you would want that trade to mature on the upside. and those stop losses would remain. As long as they are not violated first
Right.
and the targets come, you have a winning trade.
Just very quickly, if an investor knows a support and a resistance, how does one determine the risk return of a trade? So when do you say that, okay, this is worth going into or worth buying rather? What are the aspects that come into play there? Is it support and resistance that would be something you'll be watching out for?
Yes, Samina, definitely. Support resistance are very critical in determining the risk reward. Now, what is risk reward? Basically, when you're talking about risk reward, it is how much you are going to make or how much you are going to lose out of a trade. So I would put it like this. It's like how much is the pain in loss of money for the
Right.
potential gain that you're going to make out of a trade. So that's how I would put a risk-reward relationship. Normally, when you're getting into a trade, as analysts, we would normally prefer to have a risk-reward ratio of risk is 1, then we would have at least a reward of 2. That's the minimum benchmark which we put. Now, this benchmark is actually put based on the expected move, expected target.
Right.
But just because that is a target doesn't mean that the price has to go there.
Okay. Also, Sarvendra, this is...
I'd like to add on that, just
Right.
as I said,
Yeah, sure.
a simple technique, since this is a show for beginners.
Yeah.
A simple technique would be, as I said, to put a percentage filter.
Okay.
So if you assume that there is
Support is
a
57.
there is a support at X, then
Right.
X plus 3% is the area where you will want to initiate that trade. Looking
So that, okay, so that's convincing in some
Yeah,
way of,
yeah.
okay. Okay.
So that the hold is convincing, the support has been held, and the prices have moved up 3% higher, and then you would definitely want to look at secondary tools, as he said, candlesticks. Then
Right.
you want to look at volumes. Are volumes also rising along with price?
How does an investor decide when is an appropriate time to average out? Is there something like averaging out even exists? Is it a sensible thing to do?
See, in my dictionary, if you ask me, we don't average losers. So if a trade is already losing something for you, you would not want to average it out, right? At the start of a
cut your
trade, a
loss.
technical analyst would always have a stop loss. He'll have a target, right? So if the stock is not going to its target, it's going to its stop loss. So as it is, you are going to lose money, and you have a strict stop loss. You want to exit that trade. As a technical trader, you don't want to hold that trade from 140 till 40. Definitely not. If an RNRL I bought at 140, I would have definitely not held it till 40. So I would have exited, say, at 120,
Long
100, 180, 60, anywhere,
Right.
depending on what was the kind of potential upside that I was seeing at that particular point in time. So if RNRL was at 140 and I was expecting a target of 60, so with a basic risk reward, or I was expecting a target of 200, so which means I was expecting a profit of 60 rupees.
Yeah.
60 divided by 2, 30 rupees is my stop loss. So at
And you're out of
110,
that.
I am out of the stock. Now the best case, if someone is hell-bent on averaging, is that you average very close to the stop loss level at around 110.
Okay.
And if that is broken, you
Then you
exit
know
the
you're out.
entire quantity.
Right.
That's it.
What
One
about-
averaging
right.
around the stop loss, and if that is
It
hit,
works, it works.
it
doesn't,
works,
doesn't.
then fine, or else you exit.
So very lastly, Sarvendra, I mean, we've talked about a number of factors that you need to actually access this information. Where does a retail investor find all this information? And of course, what are the charts that he looks at?
See, we are lucky that both our exchanges have got decent charting tools on their website. So both BSE and NSE, people who have just freshers or just started to look at charts can definitely go to that website and look at the basic charting tools that are available. And then it's more of use and play kind of a learning exercise, what you do with an hit and trial method.
Right,
You
okay.
continue to learn. There are websites, there are reading materials on broker sites where
Okay.
university sections where you can go and read about technical analysis or
And start
things
learning.
affecting the market.
Right.
And then you start on your own, one by one, step by step. But one thing that you need to keep in mind is that there are just 3 types of basic charting. Apart from there are so many
Right.
other types of that people do. But to start with, a fresher can look at basic line charts, which would only take closing prices of the day and
Right.
plot them on the chart paper. Then you have bar charts, and then you have candle charts, which
Those are the
both
3
are
basic.
more or less similar. They will give you all the data points of the day, which means they will give you the high, the open, the high, the low, and the close, so
Closing.
which is called an OHLC chart.
Okay.
So they can start with that and start looking at
And
that.
then
on the
gradually,
script.
of course, build
and then
on that,
gradually
really.
keep on reading at broker sites, on their university sections, or search on Google and go to
Right, okay.
good stock market sites. One
And then
site
read.
that I can definitely say is stockcharts.com, where there's a
Okay.
lot of material to
Right.
be read on technical analysis.
Hemant,
One thing I would
Yeah.
like to add here, Zamina, is learning technical analysis is very easy. Learning the tools is very easy. but applying them
Applying
takes
it, I
a
guess
little
that's
time,
where
because
it's again hit
ultimately
and miss,
technical
right,
analysis
experience.
is a weight of evidence approach. Just the
Right.
way as a judge would take decisions, say we are different
So,
lawyers.
yeah.
So, different kind of indicators give you different kinds of signals. So going forward, what are the different indicators, what are the different tools what kind of signals are they giving? So you
Right.
need to weigh them. And then after weighing them, you need to understand who is more important, who is more critical, or whose side the judgment has to be taken.
Right. Very lastly, if I were to ask you this, Hemant, what are the chances or what is the success rate of using technical analysis? If you could, I mean, I know there's no round figure on that, or there's no...
I would put it like this: you need to practice, because if you do your chartered accountancy, you put about 3 years of education. You would do your medical, you put 5 years of education.
Okay.
You can't be a technical analyst doing a 2 days workshop.
Right.
So you actually need to put a lot of efforts. As I told you, learning things in technical analysis are very simple. So people feel it's so very easy.
Right, but
Application is what is more critical. So you
Right.
need to apply. Once you apply, your probability of success on trade starts increasing.
Okay.
So even if you attend a level of 7 or to 8 trades which are correct on a 10 trades, and if you allow those correct trades to actually move ahead,
Then you're home.
So the funda is that you keep your stop losses strict and allow your profits to trail.
Okay.
So trail your profits and put your stop losses strict.
Right.
If you follow this principle, I think you will be successful as a technical
Right.
analyst.
Right. Thanks very much, Hemant and Sarvendra, for joining us today on NDTV Profit. Well, that's all the time we have on this show. Thanks very much for watching.